Next chapter, Commercial Arithmetic. Now, commercial arithmetic deals with operations and computations in commercial activities such as borrowing and lending money, hire purchase, taxation, appreciation and depreciation. Principal, rate and interest. Now, whenever money is lent out, a charge is levied on that amount for the duration that money will be lent. Equally, when deposited in a bank or a circle, the money earns some more after a period of time. Principal is the amount deposited, lent or borrowed. Interest is the excess amount earned or charged on the principal. Rate is the percentage charged or earned after a certain period, usually per year. Simple interest. Simple interest is the amount charged or earned on the principal only. It is calculated as a percentage of the principal amount per annum. If an amount P is borrowed at an interest rate of R% per annum for a time period T years, then interest I is given by I is equal to P times R times T over 100. And so if 100,000 is lent for 3 years at 4% per annum, simple interest will be 100,000 times 4 times 3 over 100, which is equal to 12,000. And so if I wanted to pay all the amount at once, he will pay both the principal and the interest accrued. That is 100,000 plus 12,000, which gives us 112,000. Note that simple interest is only calculated on the principal amount irrespective of the time. For our case, the first year earned an interest of 100,000 times 4 times 1 over 100, which is equal to 4,000. Therefore, the total amount after 1 year will be 100,000 plus 4,000, giving us 104,000. However, interest for the second year is calculated from the initial 100,000 and not from this current 104,000. And therefore, each year the principal amount 100,000 will earn 4,000. For 3 years, that will be 12,000. Simple interest is the same each year and is therefore proportional to time. The difference will be clear when we do compound interest next. Compound interest. Now we have seen in simple interest that the total amount is equal to principal plus interest. If the amount at the end of the first year is taken to be the principal for the second year, the interest earned is called compound interest. Taking the same example, 100,000 in 3 years at 4% per annum, now in compound interest, in the first year, interest will be 100,000 times 4 times 1 over 100, which is 4,000. And so the total amount at the end of the first year will be 100,000 plus 4,000, giving us 104,000. In the second year, principal will be 104,000 this time. Rate will be still 4% and time will be 1 year. The interest earned in the second year will be 104,000 times 4 times 1 over 100, giving us 4,160. Total amount at the end of the second year will be principal plus interest. The principal was 104,000 plus interest 4,160, which gives us 108,160. This will now be the principal for the third year, and so interest will be 108,160 times 4 times 1 over 100, giving us 4,326 and 40 cents. And therefore, The total amount at the end of the third year will be principal plus interest. The principal was 108,160 plus interest 4,326.40 cents, which gives us a total of 112,432.40 cents. The total interest will be interest for the first year 4,000 plus interest for the second year 4,160 plus interest for the third year 4,326.40 cents, which gives us 12,486.40 cents. You will realize that when interest is compounded, it is more than simple interest. The reason why compound interest earns more is because the principal amount for each successive year is calculated from the total of the principal amount of the first year plus the interest earned. Now we look at the compound interest formula. Now, taking principal to be P, rate of R% per annum, and period or the number of years to be N, total amount to be M. Interest for the first year will be interest is equal to P times R over 100 times 1, which gives us PR over 100. The total amount A1 at the end of the first year will be principal plus interest, that is P plus PR over 100. That will give us P into 1 plus R over 100. For the second year, the principal for the second year will be the amount accumulated for the first year. That is P is equal to A1. And that is equal to P into 1 plus R over 100. Interest for the second year is equal to P into 1 plus R over 100, that is the principal amount, times R over 100. So the amount for the second year will be principal plus interest. The principal was P into 1 plus R over 100 plus interest is P into 1 plus R over 100 times R over 100. And so the total amount will be P into 1 plus R over 100 raised to power 2. If we proceed and calculate the amount for the third year, it will give us P into 1 plus R over 100 raised to power 3. In general, the amount A at a rate of R% for n number of years will be given by A is equal to P into 1 plus R over 100 raised to power n. And this is the compound interest formula. And so, using this formula for our previous example, 100,000 at a rate of 4% for 3 years, amount will be P into 1 plus R over 100 raised to power n. That is 100,000 into 1 plus 4 over 100 raised to power 3. That is equal to 100,000 into 1 plus 0.04 raised to power 3. Opening that bracket, 100,000 times 1.04 raised to power 3. And we have 112,486.40 cents. The same answer we had. Let's take an example. 500,000 borrowed from a bank at 4% compound interest. Find the amount accrued after 3 years. What is the percentage profit or interest? P is equal to 500,000. R is 4 and N is 3. Amount is equal to 500,000 into 1 plus 4 over 100 raised to power 3. That will give us 500,000 times 1.04 raised to power 3. And that is equal to 562,432. Interest is given by the amount minus the principal. 562,432 432 minus 500,000 will give us 62,432. If we calculate the percentage, this is give interest over the principal times 100, and if we do that, we shall get 12.49%. Next, half-yearly and quarterly interest. Now, when interest is paid half-yearly, there are 2 installments of interest paid in a year. In quarterly, 4 installments are paid in a year. Under such circumstances, the interest rate is divided by 4 for quarterly and by 2 for half-yearly. The period is multiplied by 2 for half-yearly or 4 for quarterly. For example, if 20,000 is deposited in a bank at a rate of 4% compound interest with interest added half-yearly, the amount after 3 years will be: principal is 20,000, R will be 4 over 2, which is 2%, N will be 3 times 2, which gives us 6 years. And so amount will be 20,000 into 1 plus 2 over 100 raised to power 6, and that will give us 22,523 and 20 cents. Next, appreciation and depreciation. Now, appreciation is the increase in the value of an item or commodity. Depreciation is the decrease in value. Now, most commodities depreciate in value over time as a result of aging, wear and tear. A few will appreciate with time. For example, land will almost always appreciate, but machinery will always depreciate. There are, however, instances where land can depreciate in value. For example, during armed conflicts or the aftermath of a mining exploration, which leaves open pits and unproductive land with no aesthetic value. But in almost all situations, land appreciates in value. The rate of appreciation and depreciation are expressed in percentages. This is used to determine the value after a given period of time. For example, a piece of land cost 400,000 3 years ago. It appreciates at 3% per annum. What is the current value of the land? In the solution, we use compound interest formula. And so we shall have amount is equal to P into 1 plus R over 100 raised to power N. 400,000 into 1 plus 3 over 100 raised to power 3. That will be 400,000 times 1.0927, which gives us 437,080 shillings. In depreciation, the same formula is used, but the plus sign is replaced with a minus. That is, amount is equal to P into 1 minus R over 100 raised to power N. For example, a vehicle costs 1 million and depreciates at 2% per annum. Find its value after 2 years. Amount will be equal to 10 raised to power 6 into 1 minus 2 over 100 raised to power 2. That is 10 raised to power 6 times 0.98 squared. That will give us 960,400. Next, hire purchase. Now, sometimes a customer may not be able to pay fully for an item. The seller may accept a small amount called deposit. The customer takes the item and the balance is paid in equal installments, either weekly, monthly, or after an agreed period of time. Such arrangement is called hire purchase. In the end, the customer will have paid a larger amount than if he or she had purchased it in cash. The advantage, though, is that he or she will be using the item before fully paying for it. For example, a vehicle sells at 1.5 million. A deposit of 50% is required with the balance being paid in 20 months at 45,000 per month. Find A, the total amount paid, interest, and the percentage interest. In our solution, 50% of 1.5 million is 750,000. Total installments, 45,000 times 20 gives us 900,000. The total amount paid will be the deposit plus the total installments. 750,000 plus 900,000 will give us 1,650,000. Interest will be 1,650,000 minus 1.5 million, which gives us 150,000. The interest is 150,000 over 1.5 million times 100, and that is equal to 10%. Lastly, taxation. Now, tax is the charge levied on individuals and companies. The purpose is to raise money for governments to provide services like health, education, security, and many others. In Kenya, the government levies two types of taxes. Direct tax, which includes income tax levied on incomes of individuals, and corporate tax levied on incomes and profits made by companies. Indirect tax, which includes VAT, or the value-added tax levied on consumer goods and services, excise duty levied on locally manufactured goods, custom duty levied on imported goods, and export duty levied on exported goods. Income tax. This is tax levied on individuals' wages and salaries. Taxable amount is the total amount subjected to taxation. Allowances are also part of one's income. Pay as you earn is the amount deducted from the individual salary, that is the tax payable. Gross salary is the amount after taxation. Tax brackets or bands are used in calculating income tax. The larger the salary, the larger the income tax paid. Notice that after calculating the tax due on the income, a personal relief of 1,056 shillings per month is deducted to get the tax chargeable. Any income equal or less than 1,056 shillings is not taxable. The rates of charging income tax are revised from time to time. Now, here is a sample of tax brackets as of 2005. Now, from these tax brackets, it means that any amount earned between 0 shillings and 10,164 will be taxed 10% of that. If you earn more than 10,164, then the remaining amount will be subjected to taxation in the second bracket. That is, any amount between 10,165 and 19,740 will be taxed 15%. If you earn more than 19,740 shillings, then the other amount will be taxed in the third bracket, and so on and so on. And so for an individual who earns 18,000, the taxation will end in the second bracket. Let's use an example to illustrate how income tax is calculated. Now, suppose a civil servant with a basic salary of 50,000 per month, hardship allowance of 12,000 per month, medical allowance of 15,000 per month, and transport allowance of 10,000 per month. Calculate his taxable amount, pay as you earn, and gross salary. Use the tax brackets above and a personal relief of Kenya shillings 1,056 per month. In our solution, taxable amount is basic salary plus all the allowances. That is 50,000 plus 12,000 plus 15,000 plus 10,000. That is equal to 87,000 shillings. Now this amount will be subjected to taxation in this bracket. In the first bracket, we tax all amount from 0 to 10,164. This we charge 10%. That is 10% of 10,164 is equal to 1,016 and 40 cents. Then we move to the second bracket. We tax all amounts from 10,165 to 19,741. Now, a very common mistake is to subtract these two figures. If you do that, you will not tax 1 shilling. And so to avoid that, we often subtract the upper figure in the previous bracket, in this case 10,164. And so we have 19,740 minus 10,164. That will give us 9,576. This we tax 15%. 15% of 9,576 is 1,436.40 cents. Then we move to the third bracket. We tax all amounts from 19,741 to 29,316. We subtract the amount from the previous bracket. 29,316 minus 19,740 will give us 9,576. This we tax 20%. 20% of 9,576 is equal to 1,915 and 20 cents. And then we move to the fourth bracket. This we tax all amounts from 29,317 to 38,891. This we tax all amounts from 29,317 to 38,892. We subtract 38,892 minus 29,316 will give us again 9,576. 25% of this is equal to 2,394. The remaining amount will fall in the last bracket, that is over 38,892. But first, let's see how much we have taxed so far. In the first bracket, we taxed 10,164. In the second, third, and fourth bracket, we taxed 9,576. If we add the total, we get 38,892. Our taxable amount was 87,000. The amount that has not been taxed so far is 87,000 minus 38,892. That will give us 48,108. This is taxed in the last bracket. 30% of 48,108 is equal to 14,432 and 40 cents. Now we calculate the total tax. That is 1,016 and 40 cents plus 1,436 and 40 cents plus 1,915 and 20 cents plus 2,394 plus 14,432 and 40 cents. The total comes to 23,588 and 40 cents. This is the amount he's expected to pay, but he has a personal relief of 1,056. We subtract that from the total tax and we shall get 22,532 and 40 cents. The remaining amount is his gross salary. 87,000 minus 22,532 shillings and 40 cents will give us 64,467 and 60 cents.
If you want to go on and major in math or do honors in math or do a career in math, you really do need to be good at it. But I think too many people stop out too soon because they've had bad experiences. I think math teachers have a lot of responsibility for that. We haven't taught it so well. We haven't provided the resources that people need. And so I think if you need help, you need to get it, and you need to get it early. And you need to work at it.